All right, let's crack open the world of corporate finance. We're going to uncover the single core idea that drives almost every major decision a company makes, from launching a tiny new product to a massive multi-billion-dollar merger.
So, have you ever seen a headline like this and just scratched your head? A company spends billions of dollars buying its own stock back, and you think, wait, why wouldn't they use that money to build something new or hire more people? Well, it turns out that decision, which seems kind of strange on the surface, is actually perfectly explained by one powerful underlying principle.
So let's dive in and pull back the curtain. We're about to look at the North Star that guides the entire corporate world. And once you see it, I promise, those confusing headlines are going to start making a whole lot more sense.
So what is this North Star? Most people would probably say a company's goal is just to make a profit. And that's not wrong, but it's not specific enough. The real goal is much more focused, and that focus is everything.
Here's the crucial difference. Think of profit like a single snapshot of the company's health from last quarter. It's important, but it's just one moment in time. Shareholder wealth, on the other hand, is the whole photo album. It's the long-term value of the company as seen by the entire market, and it's all reflected in that share price.
Right. So this really nails it down. The ultimate mission isn't just about earning cash right now. It's about making decisions that convince the world that the company will be worth even more in the future. The one and only goal is to maximize shareholder wealth.
And hey, this isn't some secret academic theory. Big companies will tell you this outright. Cadbury Schweppes, for instance, puts it right there in black and white. Their main objective is growth in shareholder value. Everything else they do is just a way to get there.
Okay, so if the goal is that simple and that clear, why is it so incredibly difficult to pull off consistently? Well, it's because of a very human problem. The people running the company aren't the same people who own it.
And this brings us to a classic showdown, something called the principal-agent problem. This is really the central human drama at the heart of all corporate finance.
Let's break this down. The shareholders who actually own the company are the principals. The managers they hire to run the place day to day are the agents. Now, here's the conflict. A manager might be tempted to chase a project that gives them a huge short-term bonus, even if it's a risky move that could hurt the company's value in the long run.
So, how do you fix this? How do you get everyone on the same page? Well, companies have a few key tools in their toolbox. They try to make managers think more like owners by tying their pay to long-term results, not just this year's profit. And a big one is giving them actual shares in the company. That way, when the owners win, the managers win too.
But, these solutions aren't foolproof. Sometimes they can seriously backfire. You can end up with these poorly designed bonus plans that give executives massive payouts for hitting short-term targets, even if they haven't created any real lasting value for the people who own the company. It's a really tricky balancing act.
All right, so we've got the goal and we've got the human drama. Now let's talk about the cold, hard math that underlies every single financial choice a company has to make.
This all boils down to one of the most powerful concepts in all of finance, the time value of money. It's a simple idea, really. $1 in your hand right now is worth more than $1 you're promised next year. Why? Because you can take that dollar today, invest it, and it can start earning you more money immediately. Timing is everything.
And this concept gives us a simple, powerful test for any business decision. You figure out all the future benefits, you subtract all the costs you have to pay today, and if that number is positive, you do it. It creates value. If it's negative, you walk away. It's the fundamental filter for everything.
So, companies are making all these calculations behind closed doors. But how does the rest of the world know if they're making the right calls? Well, there's a huge public report card that's updated every single second of the day.
That report card is the company's stock price. It's not just a random number. You should think of it as the collective opinion of millions of investors, all placing bets on how well that company is going to create wealth in the future. It's a live, brutally honest poll on management's performance.
And check this out. For one company, its value on the stock market was 3 times higher than the value of all its physical stuff. Its buildings, equipment, cash, listed on its accounting books. So, where did the other 2/3 of that value come from? It comes from the things you can't really touch or put on a spreadsheet. The market is pricing in the value of having brilliant, creative people, a winning strategy, and a brand that people trust and love. That's the secret sauce that investors are really betting on.
Okay, let's bring this all home. Let's see how these big ideas play out in the real world, where companies are making massive, high-stakes bets that you read about in the news.
Take a look at this huge acquisition. When RWE bought Innogy, they paid the shareholders £3 billion. But that wasn't the whole story. They also took on £2 billion of Innogy's existing debt. That's a £5 billion bet. And the only reason to make a bet that big is if you are absolutely convinced you can create even more value in the future.
But boy, the stakes are incredibly high. Because when you ignore these principles, or just get the math wrong, the results can be absolutely catastrophic. We've seen it time and again, from Barings Bank collapsing due to zero internal controls, to dot-coms like Boo.com just burning through hundreds of millions of dollars before going completely bust.
Which kind of leaves us with one final, big question. The tools are rational, the goal is crystal clear, so why is the history of business littered with so many disasters? Maybe it's because at the end of the day, even the most perfect formulas are still in the hands of flawed, unpredictable human beings. Something to think about. Thanks for tuning in.